right, we're recording. Okay, cool. Um, yeah, go ahead, brother. Back to you. Oh, I think he's getting himself set up. Couple things I wanted to discuss with you guys, just and anyone also feel free to to chime in with questions. I know Corey and Din. I think this is maybe your first time doing one of these Q&As with us. Um, you know, feel free to chime in, and you can either type it in. If you're going to ask you're going to ask a question, especially that's something very detailed. I'd prefer it if you type it, that way I can read it through. But if you want to, if it's just a quick question, you feel free to use the mic if you like. Either one works. But pretty much typically I'll just like go through and I'll address a topic, and then people will chime in and talk ask questions as we go. But it's just an open forum. So you just chime in as you whenever something crosses your mind. So a couple things I wanted to talk about, and I went over this with Corey after hours, just randomly the other day, and there was a few people that was in there with me, and we had briefly touched on like risk management and how to how to properly size yourself, if you will, appropriately when you're entering or when you're thinking about entering a trade. So I wanted to just share some of the guidelines that I personally use, that I think will just be helpful for you, to just to incorporate into your own personal trade plan. And it's these are just some core principles. It's not everything, but these things will at least help you. And if you don't have a pen and paper out, I would encourage you to just get a notepad, just so you can take notes, and you can use these core principles, if you will, to incorporate it into your own personal trade plan. So, and this is I should also say, this builds on top of everything we've already been discussing. And like I said, I know a few of you are new here, so I would encourage you to go back and watch those videos that are posted in the education section. Basically what we're doing is we're building up over time, so that way you can develop a proper trade plan and trading methods, and good risk management. So, but anyways, wanted to share a couple things with you. This goes back to like our zone discussion, and I'll start there because that ultimately, like, that's the core of that's the core of everything, in terms of entering and exiting a trade. Because you have to be able to identify these zones, right? So one of the major things that I like to use is obviously you always want to enter in when you're in a zone, but one of the things I mentioned the other day was identifying where you are just in the macro order flow, right? And that is, am I downtrending, am I uptrending, right? Now obviously over the course of 10 years or multi years, right? Stocks are typically always in an uptrend, and they spend much less time in the downtrend. But when they do enter a bear market like we are right now, bear markets typically last like 27 months on average. That's just a let me turn this on too. That's just an average. Let's do that. There we go. That's an average time frame. So one of the things I like to do is when I'm in a downtrend, right, I like to only short. Typically when I'm taking a longer swing trade, and that's because you're trading in flow with the order flow bias, right? And the order flow bias is determined by the monthly, right? So you use your monthly, and that's what determines your order flow bias, right? So that's like one of the first steps. Like if I'm in a downtrend, I typically will go for the short side, because automatically, just by taking the short side, you're automatically putting the probability in your favor because you're trading in flow with the order flow bias. Okay. And then simultaneously, on the flip side of that coin, when I'm in an uptrend, right, I typically, when I'm swinging, I'm talking about swinging right now. Um, I typically like to go long because I'm working in flow with the order flow bias, right? And if I give myself enough time, I'm gonna be right more times than I'm wrong because I'm working with the order flow, right? When you're fighting the order flow, right, that would be a low probability trade. I like to use a shorter target, right? So low probability trades, they're gonna get a shorter target, in terms of distance, right? So like I like to call them rentals. You guys will hear me use that a lot. So, like I don't long overnight in a downtrending on a downtrending chart. I'll take a what I call a rental during the day, and that's going to be because it's a low probability target. Because in my mind, even though we just had a month of green, right? Even though we just had a month of green, just look at this from a weekly perspective, right? Like how many weeks we've spent going since the beginning of the year here, how many weeks we've spent in the red, right? How many weeks we've spent in the red. And then even these ones that are green, right? Like this was a whole downtrend, and then this wick was still it dipped and ripped. You know what I'm saying? So, the order flow bias is still down. So I like to, work with that and not fight it, right? Because in my mind, at any given time, right, the the BFI is going to take control of the order flow again whenever they decide to, shift this price. Now, whether it happens here at 413 or it happens, back here when it was moving sideways for a week at around 400, we're unsure, and that's where we use our zones and our own TA and understanding of market mechanics. But the point is, it's just from a probability perspective, you want to work with that order flow because you can just as easily like this, right? Like when I'm gonna tell you something, like when we were back here, right? When we were back here, when we had this rally from it was 380 all the way up to 416, this whole week I only took like a couple shorts like during the day, right? And I cut my swings because of this massive move. And this whole time frame, I pretty much didn't trade anything. I took a couple shorts when the setup developed, but that was it. And I simply just waited the entire time until it started getting up here, and it started moving sideways and showing me some distribution. And that's because I wanted to work with the order flow and keep the probability on my side of the trade, right? So that's like just a major point of just understanding like order flow, and it's okay to not be in a trade, right? Like I saw this price moving, right? I think I took a short here, I took a short there, and then I think these last few days I did nothing. Like I just waited. I just literally sat on my hands and I watched the price and I was like, okay, whatever, no big deal. Then when I saw it developing, I saw that move down. I'm like, we just ran up, $35. That's a pretty decent rally in a bear market. I wonder if that's gonna tap out up there. And then sure enough, it started showing me the distribution signs, and I shorted this over and over and over again every single time it came into the zone, right? Until eventually it broke, and then I went heavy once it finally broke, right? I kept shorting it over and over again, and for that, for a good reason. And the reason I was able to do that is because I understood, what the order flow bias and where price most likely wants to go, right? Where it's most likely going to go, because BFI is going to take control of that and send that price back down, either to retest this low or to make a new low, right? So, and now we're having the same thing here, where we've had this like really strong month. This month was even stronger than this rally here. it was even stronger in terms of strength and and the distance traveled over time. So now I'm watching again for the same thing. Like, is this gonna distribute, right? And we're gonna get back into this channel and start moving down, and it's gonna respect this zone, or is it gonna break, right? So I'm just gonna sit here and use those zones, to my advantage. The point is, the first thing I wanted to address was order flow bias and having the understanding, right? Going going short in a downward trending chart automatically gives you the high probability trade, and going long in an upward trending chart gives you a high probability trade. And it's okay if you're not involved in a trade. Like, it's completely fine if you're not involved in a trade, and there's nothing wrong with that. And not being involved in a trade oftentimes is making money. And that is part of risk management, because you're like, you know what? I don't like this setup. I don't like it, because I know that it's counterintuitive to the environment, So so that's the first step. And then the next step is taking a trade, especially as a beginner or intermediate trader. My opinion, you should only enter and enter trades when you're in a valid zone. Because again, this comes back to probability. You have all right, let's just look at 372 down here, right? Let's just take a look at this on a hourly perspective. All right, we established this 372 zone way back here. Look how many times it bounced off this zone. It fell underneath it once, and then look, every single time it touched it, it bounced. It's just like 12 times it bounced off this zone, right? So as a beginner or intermediate trader, just simply being patient and waiting for price to just come to you and meet you where you want to take a trade, a high probability trade, even though there's all this other movement happening in between that you could make a move on. But again, if you wait for price to come into the zone, right, you have the highest probability of something very strong occurring from here. Okay? You have the highest probability of a strong movement occurring. And you can shift that probability in your favor by developing an understanding of, is this a supply or is this a demand zone, right? It's like when we were up here at 392, right, and I was going short, it's because and we were loading puts here, and then look what happened. We had this massive move over the course of 3 days, right? But then again, we came down here and look what happened. Bang, it just shot up because this was already, previously established demand zone. And then it came back to it again, and bang, it shot up again. Bang, it shot up again, over and over again. So as an intermediate or beginner trader, I highly encourage you to only take trades in a zone. Take your trade in a zone, because it's going to have the highest probability of working out. So, or something intense happening, right? And you can look at this on pretty much any chart. I can go look at, I don't know, I'll just hop over to Facebook just because I already have those, set up. Like, you can see, I can just draw these for you really quickly, right? You can see how if you were buying at this demand zone down here, every single time it touched, right? Every single time it touched down here, you had a very high probability of success for a strong bounce occurring. So, and then simultaneously here up in the supply, right? You had a very high probability, basically after this was established right here, you could have traded this over and over again, back and forth in this range, right? Like what, 1, 2, 3, 4, 5, 6, 7, 8, 8 times. You could have taken like 8 valid trades here, just using technical analysis and understanding of supply and demand, and using your macro and micro zones to your advantage. You could have done the same thing with Tesla. You could have done the same thing with AMD. A bunch of different stocks. So, as a beginner, sometimes just sitting on your hands and just waiting for price to come into your zone. Because the thing is, when it comes into that zone, the BFI, they have a cluster of orders that's sitting there, and that cluster of orders is is sitting there in the form of limit orders or stop limit orders, depending on which side of the coin it's on, right? So when it comes into that, and you can see what happens. Like look what happened. Like it touched here and bang, it just gapped down. And then it didn't bounce. It didn't really have a hard bounce again until it got back to this demand back here, right? And then as soon as it did, it just moved sideways. They accumulated a position, and then look, it just shot up out of it. It just shot right out of it. But then again, same thing. As soon as it came back to this demand zone or this supply zone, it was met. It had a couple days of distribution, and then bang, they just stuffed it right back down. So there's a battle happening here between the BFIs. But the point is that their orders are so large. If you're trying to trade this, maybe right in the middle, right, as an intermediate or beginner trader, you may have a tough time trading this, right? You may have a tough time trading this, but trading from here, you probably have a much easier time. Trading from here, you're going to have a much easier time, because the probability is on your side, because the BFI is essentially protecting you, is the way you need to think of it. They're protecting your position. Okay? So, let me answer a question here. How do we know it will or won't break through the zone? That's happened to me unexpectedly. All right. So, let's look at it. This is actually a great question, because it's going to bring me to my next point. All right, let's look what happened. It broke the zone right here, right? It broke out. It broke this zone. Okay, no problem. Here's the thing, Din, on that note. This goes to risk management, okay? You should only be risking as a beginner into intermediate trader. Man, it depends on your account size, okay? I like to say 1%, but I know that some of you guys have small accounts. So you have maybe, less than $5,000. So maybe you're using like a 3%, 4% per trade. So what happens is this is being a fluid trader, right? Let's say you're in a trade, okay? The price entered the zone, you had a valid signal, right? A valid signal, it knifed out of it. You're like, okay, cool. I'm trying to let's just assume we can't see this, right? You're here on your trade, right? And you're like, all right, I see it pulling up into the zone, and I see price getting stuffed. And you're like, all right, nice. I'm going to take a trade from here. Let's go. And I'm going to run this trade from here to there, right? Over the course of however many days. Now, next day, price opens up, it ramps up and exits the zone. What do you do? What do you do in that situation? Okay, now you're having a structural break. This break of structure is a stop out, and it's simultaneously it's not only a stop out, but it's also a key signal for you to also go long at the same time, because you have this clearly defined zone. So you don't know if it's going to hold up, but you can look at it based on the history, right? You got 1, 2, 3, 3 times that this has done this. The thing you have to understand is the more times price comes into a zone, the weaker it gets. Okay? Write that one down in your notes. The more times it comes there, the weaker the zone gets over time. And depending on which way the price is going, like to me in my mind right now, this zone down here, as it keeps retesting, is getting weaker and weaker and weaker. And I'm waiting for this zone to break. That's what when I interpret this chart, right? I'm waiting for it to break. So this goes back to my first point about probability. I like to short in downward trending charts, right? So I'm going to look to take the short either under this zone, or if it comes back up here again, I'm going to short it again. That's it. Simple as that. You don't know if and when it's going to break, right? There's no way possible to know that, you know what? today it's going to break, right? Or tomorrow it's going to break. But what you're doing is by using the proper risk management, by not oversizing on your trade, right? By using only, 2%, 3%, okay, of your account size. Let's say you took a short from here, right? Let's say you took a short from here, right? And you wanted to open a swing. Now, instead of moving down, price moves up against you and has a structural breakout and holds. Most importantly, it has a breakout and hold, right? So let's look what happened on a 15-minute time frame, right? It comes up, look, it touches it to the penny. To the penny, rejects, right? But it comes back up for a retest and it breaks on a 15-minute candle, a almost full body candle, and holds and stays above it. That's your stop out. If you're a swing trader, that's your stop right there. You're kicked out of that trade. Maybe if you're doing a swing for 1 week, 2 weeks, then you took your entry once you had confirmation, because you'd always take entry only when you have confirmation. You don't buy it while it's shooting up. You wait for it to flatten out and then print a signal like this one, right? You have 1, 2, 3, right? You have this bullish move, then you have a red candle printing at the top of your zone. You have basically essentially a flat top that's developing here, a full body bearish candle that's breaking 1, 2, 3 previous lows. That's a signal. Then you get a continuation. That's another signal, another signal, another signal. You should take, I would be taking an entry at any point during, any one of these candles is valid for me. Any of these are valid because it's showing you that the price is exhausted, right? Now, the price moves against you next day, right? It comes up, taps the top of the zone, right? And then it knifes down like this. But look what happens when it did that. Look at this wick right here. Do you understand? Okay, you have to understand what's happening in this wick. This price is shooting down, but the reason it's wicking back like that is because there's a cluster of buy orders sitting there. If we were to look at this on a micro time frame, like this, right? Let's just go look at it real quick just to get a little examination, right? Talk about zones and risk management. Where is it? Go back over here. Let me just go to 5 minutes so it's a little bit faster. So let's look what happened, right? So it comes up, touches it to the penny, knifes down, right? But then it's developing this support here intraday, and then it moves back up. And this break right here, this is the signal for you to simultaneously go to cut your short and go long, because you have to respect your zone. Yes, Charger, your camera is working. In my point of view, it's working perfectly. So this is the signal for you to break. So you don't know if it's gonna do it or not, but based on probability that it's most likely gonna do it. That's the whole key. Most likely you're gonna win taking a short from this position, but because you waited for the zone, right? All right, maybe you took your short at 171, right? Maybe you took, and I've also mentioned to you guys about swing trading, you should take at least 3 entries. At least 3. All right? So maybe the first day, maybe you took 1, and then you took 1 when it rejected, and then maybe 1 when it broke. Maybe you took 2 entries, right? Okay. Now, you took your first entry here at 170 and change after you got the confirmation. You took another entry here at 168. Price moves against you, okay? And it pushes up against you to 162. So you get a $2 movement against you. That might have cost you maybe 20%. 20%, 30%. And you were maybe 2 entries in. So you're getting 20, 30% off of a 60% position size. It's not going to hurt you so bad. Maybe you're going to be down 10, 15%, but and from a total position size perspective, right? And that's okay. And then it breaks out to the upside, and you're like, you know what? Cool. Low probability trade, right? Because it's against the order flow bias. This is a low probability trade. I'll take a long. I'll take a long position for the day, and I'll run this up, right? That's what I'm going to do. That's how I would trade that. Because it's a low probability trade, I'll take the day trade and I'll run it up, right? I'll run it up, I'll close it at the bell, and then we'll see what happens from there. And then from there, you know, we use our high, use our high of day like that, okay? Like how would I trade this subjectively? I'm just giving you some ideas here. How I would trade this subjectively, I would use the previous high of day as a support level. If it never broke that support, I'd take another rental. I'd use that as my structural support. If it broke this level, I'd stop out. That's it. Nice and simple. Nothing complicated. And the reason that this is rallying like this is because of the earnings coming up, right? That's why it's rallying, because the earnings was delivered here, right? But then Snapchat stuffed that out. But that's why this rally is occurring anyways. So it's also not only having an understanding of price, but simultaneously having an understanding of the environment, which also brings me to my next point. Okay, using the proper risk management. Okay, 1 to 5% of your 1 to 5% of your account size per trade, nothing more. Okay, taking a trade in a valid zone. Okay. Now the next point is, in terms of trade plan, to add this to your trades, you're either taking a trade in a valid zone with a valid signal. Okay, valid zone, valid signal, right? And preferably taking the high probability trade for swings and low probability trades for a day trade. Okay. The next one is for your trade plan is catalysts. Catalysts. There is no technical analysis in the world that can beat a catalyst. There's no technical analysis in the world that's gonna tell you how price is gonna behave. Like let's say you're thinking to go short, and then Facebook comes out and says, I don't know, they drop some news, some really positive news. That is gonna blow your short side technical analysis out of the water. Period, right? Of course, we all know that. So when you have a catalyst that is potentially coming up or has already occurred, you can ride the momentum of that catalyst, okay? You can ride the momentum of that catalyst leading up to the event, okay? So like, for example, right now AMD has earnings coming up, okay? AMD historically has done very well with their earnings. I've played their earnings quarter over quarter over quarter, every quarter for I don't even know how many. So many times I've played their earnings. They're strong. Look at their stock. It's having momentum rallying into the earnings, and that earnings, that positive earnings, is what I call as being priced in right now. Okay, there is already the anticipation for the positive earnings to deliver. Now, what is most likely going to happen when they deliver the positive earnings? You will most likely see a pop, and then in that elevated volume, the BFI will also use that opportunity to unload their position. They will, I promise you, they will unload their position into that elevated volume. One example that we saw of that last week, pull the chart up real quick, is Amazon. Okay, you have a positive earnings momentum or a little. This is going with the market, but you have the positive earnings here, right? You get this big price shoot, but then the next day, what happens? Look what happens. It doesn't go anywhere. In fact, not only does it not go anywhere, it trades down for the whole day. Why? Why is it trading down? You just had positive earnings. Well, the thing is here's the thing you have to understand. One, it's against trend, right? The order flow bias is already down, okay? So the BFI is using this opportunity to unload their position. Look at how high the volume is on that day. 148 million, and the price ends up flat, right? Look at this volume in comparison to all these other previous days, right? The reason that price is flat is because everyone sees the positive earnings, they see the blowout, and the BFI is using that opportunity because they're already in. They've already been in, right? They've been in since over here. They were in way before that, and they're using that positive earnings and the volume, most importantly, the volume, to unload their position, okay? So oftentimes when there is an event that's already known like the event is already scheduled, if you will, right? You know, like earnings, for example, or like there's like an analyst day or something like that. What ends up happening is the event gets priced in beforehand. This positive earnings outcome was already priced in down here from 102. You know, this they built their position already. They already built their position up, and now they're unloading it to all the people who didn't get in early, who think the price is going to keep going up from here, who thinks this price is going to keep moving up from the positive earnings momentum. And that's why that price is closing flat on the day. So this one actually is an interesting target for me because I want to see where the price is going to go. I'll give you another example. We did this trade. Some of you are new here. You weren't in with us for this. We ran this trade from 109 on AMD all the way down to 71. Okay? This event that occurred, I think it was here on maybe 6/3, perhaps, I think was the day. Yeah, it would have had to been. I think it was either 6/3 or they had an analyst day. Now, normally they have a nice little pop. The thing is that event had already been priced in. So when the event occurred, you get the opposite effect. You get the opposite effect, right? Because it's already priced in. The BFI is using the elevated volume to unload the position. So it's contrary. You know, it's contrarian. You know, you have to understand the BFI method, if you will, of what they're doing with the price. So with these thoughts in mind, right, you can play the momentum leading up to the event, right? You can play the momentum leading up to the event, right? Just like right now, there's momentum leading up to this event, which is coming up, I think, on the 3rd this week. It's going to be right here. Watch how the price acts. Here's another great example. Here's their last earnings. Look what happened. Let's look. Let's take a look at it. See what happened. Okay? Look what happened. The earnings great. Not company's good. But look what happened here. Here's their earnings, okay? You get this price movement leading up to it. I played this earnings. I ran this whole thing. It's a few 100%. Now this also fell on an interesting day too. This was also the FOMC meeting, so it was kind of a crazy day for AMD. But look what happened. Price shoots up, market opens, look, boom, knife. Now you get the FOMC catalyst, price shoots back up, and what do? They just knife it again, right? So, you know, and then look where the price goes from there. You get all this elevated volume, and price does what? Price just trades back down, all the way back down to support, for them to accumulate their position and get ready for the next positive catalyst, which is the analyst day coming up. And they build that position up over here, and right on the event, what do? They stuff the price into the elevated volume and bring it all the way back down, even to an even lower low. So playing catalysts, and just on this point here, playing on the potential of a catalyst occurring leading up to the catalyst, right, is a valid trade setup, especially when it's coming from a zone, right? Especially when it's coming from a zone. So leading up to the catalyst is a great way to just ride the momentum. So you can add that one into your trade plan, you know. So especially when you already know that the likelihood or the likelihood of a positive or negative outcome is perhaps highly probable, right? So you can ride that momentum leading up to it. And then after the event occurs or right before the event occurs, oftentimes you're going to get a contrarian move, okay? Give you one more example. I'll just show you. I ran this trade both directions on Tesla. This was actually one of my best trades of the quarter, in fact. It was here. Okay, look what happened. I had this little zone, I had this little support here set up, right? And I had bought a long position. Now I was expecting a little bit more leading up to it, but I bought it on this Friday. Let me see, it was right, I think maybe here, something like that. I bought it on a Friday and I held it through the weekend, and then I bought it again before the earnings. This was the earnings. Now Tesla, I knew I already knew they were going to have most likely going to have a good earnings because I already knew how many vehicles that they sold, right? But look what happened. The price shoots up like $100, right? I held it overnight, cleared a couple 100%, no big deal, closed it out, and went short. Because, again, the BFI is going to use the catalyst and the positive catalyst in the elevated volume, most importantly, the volume. That's the biggest thing. BFI cannot transact without the volume. They need the volume. They have to have it. Because if they were to try to unload their position, okay, if BFI tried to unload their position without the volume, man, the price would just you would see SPY drop like $20 in one day. Okay, they have to have the volume to unload the position. Okay, so and I knew that and I understood what's happening. And then look, I took this short here for the week. Man, paid out really nice, great trade. But it's having the understanding of the catalyst leading up to it, and then how the BFI is going to respond to it. That's one of the having those two understandings is very key to your trading success, because most retail traders in their mind, right? In their mind, they're going to see the positive earnings, okay? And they're going to see, oh man, the company's doing well, but they're disregarding the order flow bias, right? Yes, the company's doing well, but look at the order flow bias. Look at the monthly chart. Look at the weekly chart. Look what's happening here. Look what's happening. This is order flow bias is down for 1, 2, 3, 4, 5, 6, 7, 8, 9 months on Tesla. The order flow bias is down, and if you really were to zoom this, take a real examination of this, like this is almost like a massive distribution level here that's occurring on this stock specifically. Okay, so you have to have a understanding of what's going on, if you will, from both sides of the coin. You can play the catalyst leading up to it, but understand the order flow bias and how the BFI is going to react to that. So that's why you often see, even here, I played this one too, ExxonMobil, right, which we all know just made more money than God, right? Okay, look what happened on their last earnings. Oops, this is not ExxonMobil. Look what happened on their last earnings. It's right here. I don't know why it's not showing, but it's right here. Look what happened. You have the positive earnings positive earning momentum leading up to it, but then the earnings get released, and what happens? The price knifes. Why? Why is the price knife? Because the BFI needs the elevated volume to unload the position. That's why. That's it. So it's a contrarian move. It's an opposite move, and that's why you often see a company, when they have positive earnings, next day knife, or maybe 2 days later, 3 days later, knife. Right? It might run sideways for a little bit and then knife to the downside. Okay, so just a couple of things you want to add to your trade plan here. Trading with a catalyst, especially when it's a known catalyst, trading the momentum of that catalyst leading up to it. Okay. And then often after the catalyst, it's typically a contrarian move. Typically, not always, but typically a contrarian move. Okay, and actually we're even seeing a little bit of that. It's kind of weird happening right now with companies that are having, they're not big misses, but they're subpar earnings, and they're having small misses, and the price is rallying, like Google and Microsoft and Micron, and a few of them that they had so-so earnings, but the market is rallying, and it's kind of weird. But oftentimes, especially for positive news, you typically get an opposite reaction afterwards. You can even see that on it's another good one was AMD, actually, when they had that crazy run over here. They had this really interesting rally here that I caught for their earnings, right? But then look what happened after that. This stock just traded down for a long time, it just basically until it got close enough to the next earnings where you started getting that positive earnings momentum leading up to it. But the earnings so good, even here, right? you get this, earnings opens up, the price bounces up, but then it knifes for 3 days before it starts making another move. Just like you just saw on Exxon, for example. Is another great example of that. And the same thing here, right? You had this great earnings run, this earnings momentum, but they just used that to unload, to distribute the position, to sell off, and reload at a more exciting price for them, if you will, down here at the 100 level, where they finally based and they took that price up to the next level. Okay, so, but again, using the proper risk management, using 1 to 5% of your account is gonna keep you in the game, especially when you're swing trading. So even if you're wrong, you're not blowing up account, you're not taking a massive hit. And I know that's going to be a tough discipline for many, but it's a necessary one if you want to stay in the game, because there's two rules to this game essentially. If you don't bet, you can't win. But if you lose all your chips, you can't bet. So you got to keep your chips. Okay, you got to keep your chips. You got to use proper risk management. So I would say, just adding some of these to your trade plan, trading in a zone, trading catalyst momentum leading up to it, looking for contrarian moves after a positive event occurs, or even sometimes a negative event. Sometimes a negative event, if it's known, like we're actually seeing that take place on Netflix. In fact, it's actually a good example of that. Subpar earnings. It's been trading down. I've been shorting this for the entire quarter, but actually had a rally into this earnings. They're most likely going to use this for exit liquidity, is most likely what's going to happen. We haven't seen this price basically since the last big earnings miss. So I'm actually looking for this price to break down. I'm curious if it's going to occur at this like 225 level. But, you're actually, getting, subpar earnings, subscribers down, and then you're actually getting a rally. And what's happening is you're also getting a short squeeze at the same time for all the shorts that were expecting a downside move, myself included. So, I got stomped out on my trade, but that's okay, because again, I'm only using, 1%, 2% of my account maximum. So even when I'm wrong, it's okay, no big deal. I'll do the next trade. I'm not gonna cry about it. So, anyways, so yeah, if anyone has any questions, feel free to chime in. I wanted to at least address a few key points. I know I've been talking pretty much nonstop for like 40 minutes now, and gave you hopefully a couple good tips to add into your trade plan, and then we can discuss any questions you have, and we can dig into this deeper. I'm gonna take a breather on that one. Yeah, okay. On a swing trade that you have your full entry, 1 to 5%, and set your stop loss, when are you looking to take profits? Okay, good question. I'll just jump back to Facebook just because I have it up. All right, if I'm swinging a trade, let's say I bought, this goes back to our measured move, right? So we know how much volatility to expect in 1 week. So maybe I'm taking a 2-week swing on Facebook, right? Because I'm trying to do this, right? I'm trying to do this, right? That's my goal, right? And then maybe it comes back down here. I'm trying to do this again. Maybe it's down here. I'm going to aim for this again, or maybe from this point now, negative earnings. We could go either way, right? So when am I looking to take profits? Here's the thing, Corey. The wholesale price for puts is in the demand zone, and the retail price for calls is, in the supply zone. In the supply zone. And the retail price for calls is in the supply zone, and vice versa. So what I'm actually, the goal is with zones, what you're trying to accomplish is you're trying to, buy it wholesale and sell it retail. So what you're trying to do is buy here on your puts, sell your puts here in your zone, buy your calls and that's what you're trying to accomplish. So you're just working this ticker back and forth, back and forth. You know that it's been taking about a week to make this move, both directions, up and down. It's been taking, 4, 5, 6 sessions on average to make this move. So maybe you're buying a 2-week contract, right? And you're, using the 2 weeks to complete this move, right? Where am I taking profits? And also simultaneously, where am I taking entry for the next move? So where I'm taking profits and where I'm taking entry for the next move is the same spot. It's the exact same spot. So what I'm doing is I'll take a zone like this, right? I'm going to just move this line out of the way. I'll take a zone, and when I have my predefined zone, I'll go like this. I'll take the zone, I'll cut it in half. Okay, let me make this one a different color. Alright, and I'll make it dotted, and I'll make it a little thicker. Okay, so we can just keep our eyes on it. I'll take the zone, I'll cut it in half. Okay, the ideal location to exit and enter the next trade is in the deep half of the zone. And that's the deep half, like that. Okay, the ideal spot is to exit and enter on the deep half. So what I'm doing is, as the price, I mentioned this to you during our live session, as the price is coming into the zone and I'm entering the deep half, okay, I'm entering the deep half, I just sell it into the strength, okay? So if I'm on puts, right, if I'm writing puts, and you know how this is, when price moves against you, you can have the same stock price, right? But if you're on puts, let's say, for example, right? If you're on puts and the price is trading down and you're at 156.20 versus when the price is trading up at 156.20, those prices are going to be two different prices, right or wrong. They're going to be two completely different ones, right? So what you do is you accept your profit in the deep half of the zone and you sell it into strength if you're able to get there, right? So if I'm in the deep half, maybe as soon as I enter the zone, I might trim a few contracts as it enters. Maybe I'm going to sell 1 or 2. As it goes a little bit deeper, once I'm in the deep half, I'm out. I'm out, and I'm going to wait for the next move to occur, whether that be a reversal or a break of structure, okay? But I'm always looking to enter and exit in the deep half. If I'm already in a position, okay? If I'm already in a position, let's say I'm running a short leg from here, right? And I entered in the deep half, I'm running my short leg. When I get in here into this candle, right here in the bottom, I'm selling. That's it. Especially at the end of a day. I'm selling, I'm out. And whatever happens the next day, that's what happens. So, but then if it reverses, right, I'm looking to take that entry ideally in the deep half, right? And these are reversal signals printing here is what's happening, right? So you can see those. Typically, here's something to understand also for everyone. Most of the time, it takes 1 to 2 days minimum, at least 1 to 2 days for a chart to make a U-turn. Okay? And you can actually see that perfectly on this chart right now. Price runs down, and then look, 1 day, 2 days, U-turn. Price runs up, 1 day, 2 day, U-turn, right? Price runs down, 1, 2, back up. Same thing here, 1, 2, 3. Typically 1 to 2 days, Now, do I set a stop loss when you're looking to take profits near your next zone or trailing stop on the way? Can you add a trailing stop of some sort? Yeah, you should always trail a stop. Yeah, absolutely. You should always have a stop open when you're swing trading and it's going in your favor. But I give it room to breathe. I give it a lot of room to breathe because the stock is gonna fluctuate. It's gonna move around. You know what I mean? So I give it a lot of room. Most of the time, when I'm swing trading, I'm working more on structure than anything. Like I'm working in a sense of, all right, if this price does something like this, right? where I entered here, I got a signal, and then it broke the structure, I'm out. You know, I typically use a structural stop over everything because I'm swing trading. The movement against me like this, a break. If I took an entry in a deep half, the break of that structure, it's not gonna hurt me that much. You know, it's not gonna hurt me that much. So I'm just gonna use a structural stop, and whatever percentage that is, that's what it is. You know, and then simultaneously, if I got a structural stop or structural break, I'll then take a low probability trade because of that structural break as a day trade to not only make up for it but actually gain some money too. So, but yeah, once I'm in a deep or in the zone, I'm tightening that trailing stop. You know, because I'm looking to exit. You know, I always have a trailing stop open, but whenever I'm in a zone, I squeeze. You guys have heard me say this in our live sessions. You know, I'll be like, hey guys, I'm tightening my stop here because I want to exit. I want to get out. Do you have a preset limit sell order in that deep half waiting to be triggered? So if I'm already in the position, let's just say I'm in calls from here. Let's just say I'm in calls from here and I'm riding it up. I'm not gonna have a once I'm in this zone, because I'm gonna be watching it live manually, right? I will set a contingent order at this deep half price to tighten that stop up, right? So if and when that price goes like this, let's go to like a 15. If and when the price goes like this, right? I'll have if and when the price, and I'm not watching it. Let's just say I'm not watching it and I just have my order here set at the deep half. If and when this price goes like this and reverses, right? What's going to happen is it's going to stop me out and also enter in or put me in a trade at the same time. And I'm going to base it off the underlying, because I'll have the deep half price already set. So I'll say, 170.68, right? Trail a stop to, maybe 0.25 might be something I might use for Facebook contracts just based on their size, right? And what's going to happen is it's going to use that trailing stop, and when this reverses, that'll take off $25 a contract. It's going to stop me out. Simultaneously, that's also going to be an entry for me because price would have reversed and came back towards that deep half and entered that it would have triggered the trade for me. So I use trailing stops and trailing buy orders at the same time, simultaneously. And neither of them will get triggered unless that price U-turns. It's going to have to U-turn for both things to occur. Yeah. So, and it also, it kind of depends. And that's if I'm not watching it. I'll just run a contingent order. Like I might do a single entry here. Let's say I'll do a single entry at 170.68. And maybe I have another entry on a contingent order on a breakdown of that zone, something like that. But if I'm watching it, I'm going to do it manually. Like if I'm watching this and I see this price run up here and then go flat for 15, 30, 45 minutes, I'm going to just sell it right there. I'm just going to exit because I'm already in my target zone. I'm already in the zone. This is not going to make a difference going from 171.32 to 172.17. We're talking, you're talking not that much. Even for my position size, like that might be the difference for like a few $100. It's not going to be that much. It's not going to be like thousands of dollars. Because of the size that I use, it's only going to be something that's whatever. It's not that big a deal. You're trying to either way, you're only trying to capture. The whole goal is to just capture 80% of this movement as a beginner. As a beginner intermediate trader, you're not going to capture 100% of a move. Even professionals don't. Because we wait for confirmation too. Because you're not going to buy the tippy top. You're not going to sell the tippy top. You're not going to sell the bottom. You're not going to buy the bottom. Sometimes it happens, but not often. So Once I'm in my target zone, I let the market. You guys have heard me say this before. I'm gonna let the market take me out. I'm gonna let the market take me out. I'm gonna let the market put me in. That's it. Like once I'm in my target zone, I'll set an order to fire. So it's like if I'm in this zone here, right, and I've already crossed the line, I'm gonna if I'm not looking at the chart, I'm just gonna tighten my stop up, right, and then I'll also set a contingent order in case that price reverses and breaks under it. I'll set one for an entry, just one entry if I'm not watching it. If I'm paying attention to it, then I'll trade it accordingly. But you guys see how I trade. I'm pretty lively with it, so I'm gonna be on it. I'm not just gonna let it just run automatically. So because it very well could have a structural break. You know what I mean? So
I'm finna tell him.
so yeah. So that's how I would operate, in a situation like that. But the point is that once you're in your zone, once you're in your zone, don't be greedy. This is the number one cancer. Number one cancer for all traders. Take the profit. Take it. Take the profit. You ran a great trade from one zone to the next zone. Take your profit. Put that in your trade plan at the top of the list. Number one. Yes, Breeze, we could talk about that afterwards, brother. Not a problem. Yeah. Number one, take a profit. Take a profit. You're in a zone. You ran a great trade. Exit. Exit. Like when I'm in the deep half, right? And let's say I exit here. Let's just hypothetical. Let's say I'm running calls from here at 157.29. I ran this trade up, right? And I took profits, right? Next day, it goes and it has a structural breakout. Okay, no big deal. I go back in. I go in again, right? It's okay. Because what is that? That's a valid signal breaking a valid zone. So let's go. Just get back in. But the problem is because this goes back to risk management. The problem is that most traders, because they oversize, they don't even have the buying power to get back in. They can't even get in. And I tell you, there's nothing worse than seeing your exact trade idea play out in real time and you don't have the buying power to get back in. So that's why your risk management has to be a backbone of your trade plan. It's not only in your position size, I should say. It's not only to limit your loss, right, and limit your risk, but it's also to give you the opportunity, because you have an opportunity cost if you don't have the buying power to get back in, right? Let's just say, hypothetical with me, right? Let's say you were on this trade and you were running calls, right? Let's just say, and you've seen price do this. SPY did this on Friday. Okay, we'll look at that chart here in a second. But let's say you're running calls, right? And you get a valid signal, price flattens out for like 45 and you're like, you know what? I'm out. I'm out of this trade, right? You exit the trade and then price goes like this and then it goes like this, right? And now you don't have the buying power to even get back in on the structural break. No good, right? No good. It's bad, right? SPY did that exact thing on Friday and we took that trade. We ran this exact setup that I'm talking about, right? A few of you were with me on it. So it ran up, right? It ran up. It knifed, right? We bought this long on that breakout of this zone. We bought the long. We ran it up, sold it, tried to go short here, got stopped out, okay? Then we waited. I think Corey was with me on this trade. A few of you were with me. We waited, right? And then it broke out. And so we ran that trade up, right? And we ran it up, So, but the point is because we had the risk management, we were able to exercise that move. But if you didn't use the proper risk management, you're not able to even get into that trade. You know, if you're doing this crazy stuff like 20% of your account, 50% of your account, full port your account, you know, doing these kind of moves, you can't do it. That's it. You just can't do it. You're just gonna sit here and you get to watch the chart run up, you know, and you're like, dang, I could have caught this. What is this? This was, you know, it's a $2 move, and I think that was good for like, I don't know. I exited at like 412 and change, right? Something like that. I exited somewhere around here, and you know, because it was getting close to the end of the day, I was like, you know, I'm good. I got a couple dollar move, whatever. I'm out. But the point is like this move right here was good. I don't know. It was like depending on what strike you took, you know, I think I was running the 410 or something like that, or 411. I can't remember, but you know, it was like you know, it's good for like 100% or something like that. So um, so yeah, you know, that's why the risk management is so important, because if you don't do it, then you have to enjoy, you get to experience the pain of the opportunity cost of not using risk management, because you see an A1 setup. Like this is an A1 setup develop. This is A1, right? And you don't have the buying power to exercise, and you don't have the buying power to trade it. And so you just sit there and cry and cry about it. So I'm gonna pause on that note. How many tickers should we be looking to enter early on in our trading journey? Okay, Corey, me as someone who trades full time and does nothing else, okay, I have a basket of about I have a basket of like 8 tickers that I watch. 8 tickers that I watch, but I typically only trade about 3 to 4 tops. As a beginner, intermediate trader, 1 to 2. That's it. 1 ticker, 2 tickers in terms of positions. You should not have more than 1 to 2 positions at any given time. That's it. As simple as that. You're not gonna have the you're not gonna be able to you're not gonna be able to manage them effectively. Okay? So you're just not. And I'm gonna tell you something right now, because I know you're not gonna be able to manage them effectively as an intermediate beginner or trader. There's nothing worse than being in trades, right? Being in multiple trades, all the same direction, and all the charts turn against you at the same time, and then you're panicking, trying to exit and enter, and you know you're panicked. You can't think. You go into fight or flight mode. All the blood is leaving. You know the what is it? You know your what is it? Frontal cortex, right? And it's leaving the decision making part of your brain, and you go into fight or flight mode, and you're gonna have a bad time. 1 position, 2 position, that's it. You know, and I think you should have a small basket of tickers, like you just said, maybe, you know, 4, 5, 6 tickers. That's it. Because you know what, man? Here's the thing. You're watching 4 to 6 tickers, right? Let's say, and I watch, like, you know, like I said, I got like a basket that I watch, okay? And you know, like on Friday, I didn't really see that many moves from those other tickers, so I just played SPX and I played BABA, you know, because there was a nice setup there for BABA, right? And that was a, you know, A1 setup there. I got a catalyst pushing the price. I called it out, but I think only one of you guys took it with me. You know, it goes back to what we discussed at the beginning of this video, at the beginning of this session. A catalyst play, right? Especially a negative catalyst. A negative catalyst, it's like when a negative catalyst occurs in the market, in my mind, the market is screaming at me. It's like, hey, free money today only. You know? Free money today only. That's where my mind goes. When I hear negative news, I'm like, time to get free money. You know, um, what are some thinking about how much of your port you should be in place? Yeah, so you're 1 to 5% if you're a small account, right? If you got a large account, 1 to 2% tops, right? If you have a really big account, 1% because you don't need more than that. Um, what are some good tickers to chart with SPY? Okay, I have a basket of tickers that I'll give you here, that you can look at as well, and trade those. Here's the thing with tickers you have to understand though, Corey. Here's the thing you have to understand. Most tickers, they're gonna run in line with SPY anyways. Okay, so trading one or the other is not going to make that much of a difference. Only time it makes a difference is if there's a catalyst at play. Um, but then some tickers are high beta, low beta, medium beta, right? So like Ford, for example, I recommend this one to you guys all the time. It's an auto stock. It trades in line with the market. It's a low beta ticker, low IV. Okay, it moves slow, right? But it runs in line with the market, right? Like if we were comparing this, I can't do it right now because the thing is blocking it. But I can't click because if I click it, it's going to cut the recording. But if you were comparing, Ford or AMD or, NVIDIA, any of these, right? For example, just giving a couple examples. If you were to compare these with SPY, they run in line. They run parallel to it. The only time you see a divergence away from that is when a catalyst is occurred or is about to occur. You'll see a little bit of divergence and the price will move away from it as that catalyst gets priced in, right? And then once it's priced in, then it runs back in line and it starts running parallel again. So what are some good tickers to chart? I like AMD, and I like AMD in the semi conductor sector because it's high beta, it moves fast, and it's highly liquid. Like Chaudhry just mentioned, you want to trade stocks that are liquid. You're never ever gonna hear me mention these little penny stock, small cap stuff. Don't mess with that stuff, man. This is for this is for this is just don't mess with it. Just don't. That's it. That's all. Especially for options because there's no liquidity there. So what ends up happening is, let me go to a stock that has um, low liquidity in the options. Okay, you know what? I think it's by one Macy's, right? So low liquidity, and typically what ends up happening, right, is in the option chain because it's not very liquid. These are all actually okay. I'm trying to think of something that's like oh, you know what? Here's one. This one typically has big spreads on it. LMT, even though it is traded regularly, the spreads. Yeah, see, look, you see, you got these big spreads on the options, right? And you don't want that. Look, you have an $80 spread on the contracts, right? Like I traded LMT during the Ukraine war breaking out, but that was it though. But the point is like you see, this is what ends up happening. You get on these ones that have low liquidity, and you got these huge spreads. $100 spread. You don't want to be involved in something like that because as a beginner intermediate trader, you can get washed in the spread. You know, you get a ticker that's maybe I don't know. The spread is like 40, 50, 60 bucks, 70 bucks, and then the price moves against you just a little bit and liquidity dries up. Dude, look at the volume and the open interest on these contracts, right? Just as an example, right? Just as one example. These have big spreads. You get the price move against you just a little bit. That's all, just a little tiny bit. Liquidity's going to dry up. That contract going to go to zero. It's going to go to zero like that. Because there's not going to be anyone there that even there's not enough players in the game to buy it, to trade it with. You got to have people to trade with, right? So, I like SPY, I like AMD, I like Ford, I like Tesla, I like Baba, I like Lucid, I like ones that move. Especially I like higher beta, tickers especially. They have liquidity, they have real price movement that swings. I stay away from these ones that have low liquidity and not a lot of option volume. So I'm always trading these bigger names: Netflix, Facebook, Apple, Google, SPY, SPX, AMD, Micron, Ford, Lucid, Baba. Those are the ones that I cycle through. You know, so you want ones that have heavy liquidity in the option chain and the underlying, right? So that way that price, it reacts. Nvidia, Qualcomm. I'm just throwing out a few names that I like. Okay, so those are some good ones to add to your notes there. So I'm going to just pause on that one in case anyone wants a question, or Charlie, if you want to chime in at all, you're welcome to.
Well, the liquidity thing,
Yeah.
I mean, I think you drove the point home. I'm pretty sure everybody's
Sure.
going to listen to what you just said. But
Yeah.
just to further the point,
Yeah, chime in.
so that you don't have to experience it yourself in your trading journey.
Yep.
With the liquidity thing, you can actually get a trade correct. You can actually get the direction of the trade correct. The price moves in the direction you want it, and
Yep.
you can still lose money, which is shit.
Yes.
It can happen.
Yep.
And what can happen is that you may, like I've done it before actually with the Dow Jones, which the abbreviation, the ticker is DIA. It typically has a lot of volume to it, but I have traded it while SPY, the Qs, IWM, all of them were moving. All the tickers were moving in one direction, and I just chose that day to do Dow. Well, Dow got the least amount of liquidity in that move, so everybody else was making 80, 90% on the trade.
Yep.
I think I closed it at like making 7%, because the only thing that happened was that the spread tightened, but nothing really more than that. No acceleration of profit. So
Yep.
that liquidity thing is a huge thing. You want to be careful with that. You want to see tight ranges
Yep.
of the bid and ask.
Yeah.
And know that there's a lot of volume in there.
Like he just said, the spread can be dangerous, especially if it had moved against him. That spread would have, he'd have got Washington spread, for example. And I've only experienced this like a couple times. Like I was trading Dick's last year. It's a low liquidity stock. And they were doing really well despite the supply chain issue and the supply chain issues that other retailers were experiencing. And I was trading a contract. The price moved against me. I think, man, it was like $2. It was nothing. It was nothing. Yo, done. Contract dead. There was no one to trade it with. That's it. Price moved against it just a little tiny bit, right? The bid ask went huge. Contract sank like 70% in no time. IV crushed. No liquidity. No one to sell it to. And I'm like, yo, it's only $2 away. It's nothing. Contract expired, worthless. I couldn't even sell it. I couldn't even get rid of it. I had no one to sell it to. There's literally no one there. Like, it moved a teeny bit, and that was it. And I was like, lesson learned. I will never do this again. So, that one right there will save you. That one lesson right there will save you money. Oh. Stay away from these low liquidity stocks. Don't even bother with these small cap stuff, penny stocks, blah blah. Stay away from that stuff. It's just you know what it is? It's a lottery. That's what it is. And humans love a lottery. They love it. The idea of buying something, buying, I don't know, 100 contracts for $1 each or $2 each, and then they go to $300, $400, $500, right? It sounds like, it sounds like amazing, right? Because it's like, man, I could spend like $100 and I could spend $100 and it could turn to like 50 grand, 100 grand, right? Something like that. Like, yeah, it could, it could, but the chances of that happening, nah, nah. Yeah, exactly. See, that's the thing though. If you trade correctly, if you trade correctly, with just regular stocks like that have liquidity and you just trade well, you can actually do that. You actually can do that. Like turn, I'm not gonna say $100, but like you can turn, $500, into $5,000, into 10. Like you can do that. But what's most likely going to happen if you mess with like low liquidity stocks and like these like penny stock stuff, this small cap stuff, most likely just going to expire worthless. So most likely going to expire worthless. So don't even, yeah, just stay away from them. Yeah, S&P stocks, S&P 500, ones that get traded a lot. That's where the money is. You want people to trade with. Yeah, pump and dump schemes. Yeah, a lot of these guys, these other guys that run Discords, they'll do that. They'll get on like a, like a low OI contract. They'll buy a bunch, and then they'll signal it. They'll signal it in their group that has maybe 500 people, something like that in their group or whatever. Everyone buys the contract. IV shoots, contract bounces up, right? They're all excited. Meanwhile, the guy that owns that's running the Discord, he's already in, right? And all he's doing is just taking their money. He's literally taking their money directly because there's no one there trading it, and so he's selling his contracts to them, and it's just a terrible practice. So it's absolutely despicable. So yeah, you will never hear me mention any low OI, contracts or anything like that in here. We only trade, multi-billion-dollar companies. That's it. That's it. Because our goal is to take money from the BFI and hedge funds. That's the goal here. So, but yeah, there are people out there that do that. It's terrible practice. But yeah, you should just stay away from that kind of stuff, anyways. Though, just don't even bother with it.
I don't really want to take money from the BFI or the institutions. I just want to join forces with them while they take money away from everyone else.
That is true. That is true.
I just want to operate I just want to ride on their shoulders.
Yeah. Yeah, they're the shark, man. I'm just a little minnow. I'm just trying to collect a couple scraps while they go and make their path of carnage.
One of those little suction fish that rides on their stomach.
Yes, exactly.
And eats the crumbs.
Yeah. Yep, exactly. Yeah, that's literally what we're trying to do. Yeah, while they make their path of destruction and make billions, I'm just trying to get like a 0.01% of whatever they get. That's all. So I'll pause on that just in case anyone wants to chime in with any comments or questions on that note. But yeah, you want to have a basket, have a basket of stocks, maybe, 6 to 10 stocks that you watch, and never have more than 1 to 2 positions. That's what I would say. I know, and here's the other thing too. Here's another thing I want to point out to you about trade plans and just existing as a trader in the space. You're not going to catch even a fraction of all the great trades that are out there, right? Like, you're just not. And you're going to see posts and other people like, oh, I just banked, 1,000% on Nvidia, or last Friday, like I just banked like 8,000% on cat calls. Like here's the thing: if you're like constantly just like jumping from ticker to ticker and just like moving around, like trying to capture everything, you're gonna end up losing. It's best to just focus on a few and then just like get really in tune with them and just squeeze the life out of them every single price movement. That's it. You could trade SPY alone and nothing else and make more money than you know what to do with. There is enough liquidity in SPY alone to make more money than anyone you know or is ever gonna meet or ever gonna meet. So like there's plenty there. So you don't need to trade everything. The only reason I even have a basket of tickers is because like sometimes like maybe maybe SPY's like having one of these days like this where it's like it's just kind of it's not really doing anything too exciting, but maybe Tesla's got a catalyst going on and I'm like, all right, cool, I'm gonna trade Tesla today. So should we be looking at making a certain percentage a week, a month, or just making the best decision along the way? That's a great question, Corey. Here's the thing. All of us, every single person that's in here, all of us have grown up and been conditioned with being a outcome focused, right? We're only focused on the end result focus, I should say, right? We're only focused on the result. And now that is important, right? Like the result is important of what you do, but more importantly than anything, if you can become process focused, right? If you can become process focused and in your trading, by being process focused, but as a result of being process focused, you're going to get the percentage that you want. Okay? So like sometimes, like sometimes, like I don't know, like all right, like let's just look at Friday, right? All of you were, not all of you, but a few of you were with me on this trade on Friday, right? And I was like, all right, I'm not gonna do anything until it breaks this level. That's it. I'm not touching anything, even though I see it developing. I will not touch it. And like I said, a few of you were in the trade with me. I was like, I will not do anything until I hit this level. And that's because I'm focusing on the process, right? I don't care that I'm missing out on that percentage, right? All I care about is that I'm trading well, right? And I'm just like, all right, as long as I make my trade with the best decision that's in front of me, right? And I was patient with it. Like let's go look at what happened. Let's just review it real quick. A few of you were there with me, right? Corey, actually, you were trading this with me, and we saw this move away, and you were like, should we short? And I'm like, no, just wait. Just wait for a stronger move. And we sat there and waited in the 5, 10, 15, 20, 25, 30, 35, 40, 50, almost an hour, right? And then finally it drifted up above, and I was like, now go long, right? And we saved ourselves from getting stopped out on a short position, and we took a long and rode it up. And that's because I was focused on the process of trading it correctly based on my understanding of the market. And whatever percentage that I end up with on that trade, that's what I end up with. But as long as I'm focused on my process and I'm doing it correctly and according to my trade plan, then I'm gonna get the results that I want in the end. You can try to, set goals for yourself, right? It's like here's a good goal to have. Instead of focusing on like just percent, right? You could say, all right, I want to have 3 out of 5 days this week green. That's a good goal to have, Or out of this month, I want to have, I want to do 3 out of 4 weeks green, something like that. Because I try not to get too wrapped up in percentage, because here's the thing, there's a random distribution of outcomes with every single trade, right? It's random. It's completely random, right? So it's like, let's just look at another example. All right. let's say like our FOMC trade that we took, right? Most of you were with me on this trade, and we went long here at 230 and ran this up, right? Here's the thing though, it was I wanted a 1,000%, 1,500%, 2,000% gainer, right? I wanted that, but the market didn't deliver that, right? We were all there for it. It was a nice gain. It was a great gain, right? We ran up from 395 to 403. It's an $8 move, right? But it didn't do the thing that I wanted. It didn't do a dip and rip, right? And that's what would have gave us that big move. But instead, it based and then ripped, right? So, and that's fine. And I'm like, all right, I'll work with that because the market is just giving me what's there. You know what I mean? So I can't force a percentage out of it, right? Like no matter what you do, you cannot force 1,000% out of this trade. That's it. Even if you had the perfect entry, perfect exit, you cannot force 1,000%. But so I'm just gonna let the market decide what it's gonna give me in terms of percentage wise on the trade. But as long as I'm focusing on trading it correctly, then I'm gonna come out a winner. You know? And even on days when I lose, right? Even on days when I lose or I don't make as much, right? Like this one here, like on this day, I waited. I didn't buy this dip, right? I didn't buy this dip because it was in no man's land. There was nothing really here for me, you know, to make a move on it, right? So I waited, and I waited maybe a little too long, and that's okay though, right? And I waited until it got to, I think it was like here. I got like right there, something like that. When when I ran this trade up from, from here to there, right? But from here, making this move from this point to this point, like up here or whatever it was, right? Making this move, there's no way I can squeeze a 1,000% gain out of that trade or whatever it was, right? Or 2,000% goal. I can maybe only squeeze a 300% or 250%, right? And so that's why I don't like to get too focused on, percentages for weekly, monthly. I'm just focused on trading well. That's it. As long as if I'm not breaking rules and I'm trading well, that's all that matters. That is it. You just focus on trading well. That's the goal. Don't get too wrapped up in the money. I know it's hard because this whole game is about money, right? But if you focus on your process, the money comes as a result. That's it. The money comes as a result. And you know what? Sometimes I get to the end of my day and like I'm not even looking at the dollars, right? And because I already know what my position size is, and I'm just clicking in and out of trades like fluidly. I get to the end of the day and I'm like, wow, my account's up 2% today. I'm like, wow, great day, like amazing, fantastic. You know what I mean? So, because I got so tapped into the zone and I'm just focused on my process for the day, and I just disregarded the money side of it. So, disregarded the
question
percentage.
the question that
Yeah.
Eric is answering and that Corey
Yeah.
asked in the chat, that as a trader, that is something that you will struggle with for a long time.
Yeah.
Unfortunately,
Yeah.
everybody does.
Yeah.
You will return to that same question over and over and over again.
Yeah.
Because Eric can give you the answer, you can hear the answer, and you'll know the answer.
Yeah.
But it's very hard to unwire that out of your mind of not focusing on the money.
Yeah.
And systematically trading.
Mm-hmm.
It's a psychological battle as opposed to the answer, what is correct.
Yeah.
So just expect to deal with that for a while.
Absolutely. Yeah, you'll always deal, like to his point, to Chaudhry's point. Yeah, you're always gonna come back to it because all of us that are in here, we're all, 25 years or older, 30 plus, right? We've all been conditioned for 2-3 decades to only focus on results, right? Everything is a end result. What's the bottom line? You took a test. What grade did you get? Was it a 90%? Was it 85%? Did you get an A, a B, C, D? Like what was your, what was your grade? What was your GPA? Like result. But it's like, hey, yeah, maybe I got a C on this test, right? Like, okay, like maybe if we're looking at this chart right now, right? I didn't get an A on this test, right? I got a C plus, okay? I got a C plus on this test because I only caught 70% of the move, or whatever. I only caught a chunk of this move, not the whole thing, right? All right, I got a C plus, but was my method of getting that C plus, like the method that I took to get it? Did I do well? Did I get it in the right way, in a safe way? You know what I mean? Or did I gamble trying to get an A? You know what I'm saying? Did I gamble trying to get this A, or did I get a safe C? I'll take a safe C all day. You know, if I can get 50% of a move every single day, right? You get 50% of a move every single day on a 1% position size on your account. By the end of this year, you're gonna have a strong six-figure account. I don't care what size your account is right now. You get 50% on 1% every single day, you're gonna have six figures by the end of the year. So, like, that's it. Simple as that. Like, that's what's gonna happen. So, and that's only getting half of a move. So you don't need to get everything. So don't get too, try not to get too wrapped up in, percentages, if you will.
And just to reinforce, because what will happen the further battle is, even if you do focus systematically on your trading, and which a lot of people struggle with, even if you do, to reinforce what Eric said, the market decides what it wants to give you. You don't decide what you're going to take from the market.
That's right.
The market decides what it's going to give you. So you can have the same setup, the breakout, everything's meeting your criteria, your rules. And let's say we're trading SPY. One day, it may give you $6 as a move. Another day, it may give you 80 cents and turn around. So that's just something you have to accept. That's why it's so difficult to focus on percentage return, as opposed to just following your process.
Yeah.
So,
Yep.
I was going to ask something earlier,
because
it's something I had done this weekend. I don't know. Everyone trades a little differently, because everyone, when you get into your groove, when you finally find yourself as a trader, you'll find out that your mind doesn't work the same way as Eric's, and Eric's doesn't work the same way as yours. Nobody's does.
Yeah.
So you have to find what works for you. So people will end up mixing different indicators or different ways of drawing support and resistance, or possibly using trend lines in a different way. And that's something that you have to discover. If you do not have a trading plan or rules or any type of system to follow, then everything we're saying kind of goes out the door. Because what rules are you actually following when you make a trade?
Exactly.
You have to have the same rules in place for every single trade. If you don't, there's no way to systematically trade.
I want to make a point on that before you move on, Chaudhry. Here's the thing. There's, like he just said, there's a completely random distribution of outcomes to every trade. Like he just said, maybe one day you're going to take this trade and it's going to give you, what's this? Going to give you $5 or $4, right? Maybe the next day you're going to take this same exact setup and it's going to give you $12, right? But the thing is, or maybe the next day is going to give you, 50 cents, something like that, right? You don't know. You can assume, but you don't know. So because the distribution is random, right? The outcomes are random. The problem is if you don't have a trade plan and you don't have a clearly defined system, what happens is, because the system is your system is random, your trading is random. And because your trading is random, your personal outcomes are random. And what happens is you're going to become a boom and bust trader. Because nothing is, you don't have a constant, you don't have a base to work from. And so over the series of over the series of 20 trades, you take the probabilities and you just, they're just, you ruin the probabilities because you're not working the same system. You know, you ruin it if you take a 1% size on this trade and a 5% size on that trade and a 3% size on this trade. Man, you're gonna have a mess. It's not gonna work out. It has to be, you have to have, in an environment that has a random distribution of outcomes, you have to be the control. You and your trade system has to be the control, because that's the only thing that you have any control over, is you and your trade system. And again, if you don't do that, trust. I've tried it many other ways. I'm like, oh well, this trade is a high conviction trade, so I'm gonna put a little more money. Well, this one is a low conviction trade, so I'm gonna put less. I just work the same trade plan over and over and over again. And what I've realized is that my outcomes are way more consistent by doing that. So you have to have a trade plan, clearly defined, written down on paper, not here, written down, clear. You know, so it's like, all right, you know, when Monday opens up and you know, I'm trying to trade SPY, I'm looking at the SPY and I'm like, okay, cool. If it breaks over 413, I'm gonna go long. If it rejects 413, I'm gonna short it. If it bounces off of 410.71, I'm gonna long it. If it breaks 410.71, I'm gonna look to 408.27 to short. You know, and I have to have that trade plan and work with that. You know, or if it breaks 410.71 and reverses again like it did here, I'm gonna long it again over 410.71, right? So I have to use those zones to trade subjectively, right? You know, so maybe even as a beginner or intermediate trader and SPY opens up at 411 or 410.71, maybe you don't even do anything. You're just watching, and you said, you know what? I'm not gonna do anything until SPY goes down to 407, right? Or I'm not gonna do anything until SPY goes to 416. I'm not gonna do nothing. And while it's in the middle, I'm not even gonna touch it. I don't care what happens while it's in the middle. Let it bounce around until it's at a valid zone and it prints a valid signal. Speaking of trade plans, 2 questions. What are the factors that you consider in a trade plan? What is your personal trade plan for SPY, AMD, and Ford this week? Okay. So,
I think we might be speaking of 2 different things.
what do you mean factors? When you say, look, can you give me a little bit more, like what criteria I have for entering and exiting? Is that what you mean?
I can tell by his second question that he's I see what he's saying. So here's what to not get confused. A trade plan is not predicting what is going to happen in the market. The people on Twitter that say, "Here's my trade plan for the week," are idiots. That's not a trade plan. So,
okay.
Trade plan is you're looking at the charts and you're seeing a trade that you believe is going to set up, and your trade plan is, here's what I look for. Does this match the criteria of what I need, you personally need, in order to take the trade? Does it do this? Yes. Does it do this? Yes. Does it do this? Yes. Okay, I'll take the trade. That's a trade plan. It's a structure. It's a structure to taking a trade.
I think I have a bit.
As opposed to being like these guys on Twitter where they're like, yeah, I think it's going to move to 650 first, then it's going to come down to 618, and then it should go to 690. That is nonsense. That will forever be nonsense.
Ali. So for me personally, okay, I can trade more subjectively because I have more experience. Okay, so let me just start with that. And because this session has been more focused towards a beginner or intermediate trader. Okay, but me personally, I can trade more subjectively because I can read and react to price very quickly, and I can make decisions based on what I'm seeing, and weigh out a multitude of different factors, right, and all these variables in my head very fast. So most beginner and intermediate traders are not going to be able to do that until they put a few thousand trades under their belt, right? So, but at the core of my personal trade plan, where I like to trade, because I like to be a swing trader. That's what I prefer. But I can day trade just as well. It doesn't matter to me. But I prefer to swing trade just because I understand the probability of success. So I prefer to swing trade. And with that being said, when I'm entering a swing trade, first thing before anything else, first things first, I have to be in a zone. That's the first part. I have to be in a valid zone. Now, whether that's, let me just move this out of the way. You're looking at my zones right now, okay? You're looking at, I'm going to get rid of this trend channel. Right now, you are observing my zones, okay? If I'm entering a swing trade, I'm not doing anything, nothing, absolutely nothing in this space. I'm not doing anything in here. I'm not doing anything in here, okay? I'm only entering and exiting trades between these red lines, green lines, red lines, green lines. I might do something at the 380 level because it's a pivot point. So the first step for me of entering any swing trade is valid zone, valid signal. Period. That's the first step. Next, like if that doesn't print, forget everything, right? They just throw it away, okay? For a swing trade, so first step, valid zone, valid signal. Now then, the question is, what environmental factors are going to influence this trade? Does the company have? Let's just say I'm trading a specific ticker. Is there a catalyst coming up? Is there a catalyst that just happened? When's their earnings? Is there earnings coming up? Did it just happen? How was it? What was the print look like? Okay, so I'm going to weigh out those environmental factors, right? So that'll be the next step. Am I trading with market flow or against it, right? So, even if a company's doing bad, let's say, right? Even if the company's doing bad, but the market is ripping to the upside, it's going to go up. Most likely. It has to be a really terrible catalyst news like Baba had on Friday, right? For it to trade down and trade against the market. So you have to weigh that environmental factor as well, right? Then the next step for me, I'm going to also look at the option flow, right? Where is the BFI want to take the price, right? Where are they putting their money? Because who am I with a little, $2,000, $3,000 position size, right? I'm coming into the market like, oh yeah, I'm gonna move the price with my $3,000 position. No, right? The guys that are gonna move the market are the guys that have, $5 million option contracts and have $50 million of underlying. You know what I mean? Like that's who's moving the price. So I'm gonna see what these guys are up to, right? So valid zone, valid signal. What environmental factors are gonna influence the specific ticker? Where's the market trading overall? Well, how's the whole entire, the macro, right? How's that looking in comparison to those? And then where the BFI is positioning their money for a future, right? So that's a typical, trade setup for me, right? Those will be like, the four things the four biggest things that I'm going to look at before I even consider entering a position, and then the last one, of course, will be catalyst, right? If there's a news that comes out, like I mentioned earlier in this chat, if there's some catalyst, that comes out in the middle of the day, okay, or even before the market opens or after, or whatever it is, especially if it's negative, like that. When it's negative, it's just like my eyeballs. When I hear the negative news, my eyeballs just disregard everything else that's going on in the market, and I just magnet straight to that ticker and see and I look for an entry when there's negative news, right? I'm looking for an entry to take it, and that may be a more subjective trade, but for a beginner, intermediate, that's how I would recommend setting up, just as a core values on your trade, right? Is valid zone, valid signal, weigh out where BFI is putting their money, look at the specific ticker that you're trading and what catalysts are coming up and what has happened previously, and then also weigh out the entire macro perspective of the market, right? It's like I'm gonna give you one. Actually, there's a great example of this. All right, I've been shorting this stock for man too long, but let me show you something odd that happened to me. I'm gonna show you something odd. Okay, I was trading this stock here. Okay, I was shorting this stock. I've been shorting it. I short this stock on every single pop. Okay, Bed Bath and Beyond. It's a trash stock. I've actually made a lot of money on this one. Okay, now this stock had trash earnings. Okay, trash, absolutely trash, and I didn't understand. I said, man, why is this stock not trading down? Now the market overall was trading up at the time, but the earnings were trash, man. So I couldn't understand what was happening, and I had a swing open on it, and it just didn't do anything. And then finally, I understood why it wasn't moving. There was a news that was waiting to be released here, and there was insider trading that was happening. And so that price didn't move for 1, 2, 3, 4, 5, 6 days. 6 days, this thing, 7 days, 8 days. And my swing was just getting wrecked here. And it made no sense because the whole market ended up trading down during this time, and I couldn't understand what was going on because I'm like, how does this stock have so much strength? And that's because there's insider trading taking place, and they were waiting for this news to break. They bought a bunch of option contracts the day before, and they popped it. They sold their position, and then it finally started. Once that news finally came out, then it started to trade down. Now, obviously, you can't beat insider trading. There's no way. It just is what it is. But the point is like, weighing out environmental factors, right? Weighing them out and where the BFI is positioning themselves. I should have been a little bit more in tune. They were very sneaky with their orders. They snuck them in right before that news came out. But it is what it is. So, but weighing out environmental factors and also trading off the momentum of catalysts is always a good move. But yeah, these guys, they got me good. They got me there for like $1,200 on that one. But in terms of loss, what's my personal trade plan for the SPY, AMD, and Ford? So for the AMD, because they have the earnings this week, I'll look for a break over the close on Friday, right? And maybe enjoy a little bit of that IV squeeze. So if I see it keep pumping, from here and up, I'll take a rental long on it. I think the earnings is on the 3rd. It's either the 2nd or the 3rd, one of these days. So maybe I take 2 rentals for a couple days in a row. I'm not gonna hold it through the earnings though this time around. I'm not gonna hold it through. If it pops through, if it pops, great. I'll look to short it afterwards again. So that's my plan for the AMD. So I might take a couple rentals over 94.50 basically. Over 94.50, I might take a couple rentals to the upside for 2 days, and I'll enjoy the IV squeeze too, which will be nice because the positive earnings are going to be priced into AMD. So and they'll most likely deliver well. Most likely, Lisa Su does a great job. So she's fantastic, and this is just a company that's doing great in a very terrible environment. Honestly, I don't know if you guys read the results of their analyst day that we shorted, but the company's doing great, even though we shorted it for $40. most likely going to have a positive move, but I think that these contracts are going to be so heavily juiced with IV. I'll see how the IV is. I'm probably not going to play it through the earnings because I'd imagine that the IV is going to be just absolutely insane. Let me see what it closed at, just out of curiosity. It's actually not that high. It's for AMD, 70 is not that high. But yeah, I would imagine this IV is going to be well over 100 coming into the earnings. So you get to enjoy the IV squeeze with the potential of an upside move there. And then, if and when they do beat, I'll look to short it afterwards. So that's my thoughts on the AMD. As for the Ford's going to continue to trade positively because they had that beat on earnings. They'll continue to trade positively until the market turns, most likely. So again, kind of similar situation. Now you already have the data, so I'm just going to look for Ford. I'm just going to look for Ford basically to trade. Ford trades with SPY, so they trade together. So I'll be looking for Ford about right here, about 1470. So I'll look for strength over 1470 for it to keep pushing higher, and that's if the market's pushing with it. So this will be a good one to continue to push higher because of the positive earnings momentum. So I'll look for it to push higher, but then once SPY turns, or I start seeing some serious bearish movement, like something like this, right? Like a big dagger develop, I'll look for maybe some distribution to take place on the Ford at these higher prices, something like this to occur, like this kind of price movement where it's chopping back and forth for a couple days. And then at that point, that's when I'll start looking for the short side. But if the market keeps pushing up and SPY pushes up towards the 416 level, then I'll look for Ford to keep going higher. That'll actually be a good one for anyone who's in here who has a small account or large account too, doesn't matter. These contracts are very cheap, so you can play them really close to the money and make really good money. I think these contracts last week, like the 13.5s, which are really basically at the money, they were like 500% at the low from the day before, just in one day. Even if you played after, so it was like I don't know, like $20 on the 14s maybe. I think it's like $20 to like 150 a contract, something like that. So it's a good ticker. And then for the SPY, it's same thing for the SPY. I'm watching my zones here on the SPY. Let me just move these boxes that I drew earlier. So I'm just watching my zones from the previous CPI print. So I'm going to be looking to see if we're going to get some distribution. I will say that the first time it comes back and touches, if it does get up to the 416 level, the moment it prints a bearish signal, I'm going to short it nicely because there's going to be orders sitting there. So if and when it does get back up to that 416.5 level, I'm definitely going to take a nice short on it because that would be the first retest and it's going to have the strongest move. So I'm just going to be watching my zones in terms of swing trading. Either a breakdown under the 407 again or a touch and reject at the 416. Either way, I can play any direction. Or if it wants to push past it, okay, that's fine too. Go for it. Either way, I'm just going to work it off my zones for a swing in terms of swing trading. And then for day trading, the price levels that are important to me is going to be right here at about 412.71, right here at the 410.70 level, and then right here at the 408.27, and then at the bottom here 407.24. So based on how price is reacting to these levels, that's where I'll be making my decisions to either go long, go short, etc. So hopefully that answered your questions there. Chris, I was looking at you posted Friday. What? I was looking at your. Can you watch to see if SPY will reject where it? Oh, can you edit this? The grammar's. I'm having a hard time here. I was looking. No, it's just typos. It's just a couple typos. Can you edit it so I can understand you better? Watch to see SPY will reject depending where it opens. Up at rejected 413 level Friday, 410 would be, or could be a key. If it break that, we can see 40740. Okay, yeah. So for zones, okay, All right, I think I'm understanding you. Um, so for zones, like I just mentioned, I have my zones already marked in red and green, right? So the red and green, those are going to be the biggest key levels for something exciting to happen, right? Intraday levels, I'm going to also watch this 41070 and 41270. Actually, it's $2 exactly apart. So I'm going to watch those two levels intraday just to see, so price may just open up flat in between here. I think futures were down a little bit. So I'm just going to kind of see where, how it reacts here in between these levels. But for the highest probability trade, the highest probability trades are going to occur between 407 and 408 and 414 to 416. So that's where, for beginner intermediate trader, for all you guys in here, I would not do anything until it's hitting one of these prices to swing. I wouldn't do anything. I'll wait. I'll wait to see what it's going to do. You know, I will be, if depending on where price opens up, I still will plan to take trades, in between the zones, because I can trade a little more subjectively, and that's okay for me. But as a beginner intermediate, I would highly recommend you wait for a retest of those zones. I will say though that, like I just mentioned a minute ago, the first retest of that 416 level up there at the top is going to be a highly, even if price is going up, even if it's just a day trade, that retest of 416, high 415 level, like the deep half of that zone, like basically, let me get on a 1 hour. So the deep half, so looking at, basically from here up, basically from like 415 and a half up from there, like that little $1 range, if I start seeing bearish candles develop there, like on a 5 and 15 minute time frame, I'm definitely going to be looking for a short side move, because that can easily make a nice like $7-8 move to the downside, like no problem, like no problem at all. So yeah, I'm looking for potential distribution to take place here at the top again. Yeah. But for beginner intermediate traders, wait for that retest. You're gonna do better if you do. Like, you can wait for, if it price knifes down here and it starts showing bullish again, you can look for another bounce, right? Look for another bounce to the upside, and then just use these levels right here to potentially look for price exhaustion. That's definitely going to be the key there. So yeah, this will be an exciting price level to trade at, just like it was last time. I really enjoyed the price action that was here last time. It was great. I made a lot of money right here. There's nothing better than when price is range locked like this. When price is doing this, it's the best. Like a lot of guys, they stay away from that. They call it chop. This is where I make money. Like that's what you want. Like you want this type of price action. Like that's like the this is the best. It's just range locked, like nice and tight. You just run it back and forth just over and over again. So we can talk about Baba. Yeah, we had touched on it earlier, but yeah, we can we didn't really dig into it. We can talk about Baba. Yeah, I'm looking to short Baba again on Monday. I had to close my contracts because I was just out of time. But so for the Baba, I'm gonna be mindful of a potential dead cat bounce. No, it's cool. It's all right. We didn't really dig into it, so it's fine. I don't. Yeah, we haven't really touched on it at all. So I'll be mindful of a potential dead cat bounce. So I'm gonna look for. So you see, I already got a couple price levels here. Let me just go to a 15. You'll see why I have that. So I'm looking for, I don't know why that one moved. So I'll be looking for these price levels in case it does dead cat bounce. Like if it does dead cat bounce, I'm not going to take a long side on it. I'll tell you that right now. I've been shorting Baba for like, I don't even know how many months, over a year. But I'll look for, if it does dead cat bounce, I'll look for that, or I'll look for this, okay? Like that kind of movement. And then if it does go higher, I'll look for about right there. I'll look for that to take a short again. So this is a more subjective trade because you're not trading in a zone. So that's my viewpoint though on the BABA. But ultimately, my target, like if we break lower, like let's say we open up and we open up flat, and then it breaks lower from there, right? I'm just gonna ride a short right from 88. Was it 88.60?